Good afternoon, fellow traders. Thank you for attending today's webinar um, about advanced FX trading strategies. This is another webinar in our Blue Sky Forex webinar series. And before we continue any further, can you just confirm in the question section whether you can properly hear me and can see the presentation screen? Great, perfect. Thanks for the confirmation. So while the last people connect, let me just quickly go through the disclaimer, so bear with me for a moment. Contents of this material are provided by third party, not Hot Forex, and are for informational purposes only and do not constitute investment advice. Hot Forex and Blue Sky Forex assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Hot Forex unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if necessary. So with this out of the way, now let's just go through the agenda quickly. First of all, I will quickly introduce myself. Then we'll take a look at two market types you will come across during your daily trading activities. We will then talk about 4 Blue Sky Forex core trading strategies. And then, of course, risk management along with it. And last but not least, we'll discuss currency trading dangers that applies at all times, no matter what strategy you are using. And you can also ask your questions in the end. So please, if you do receive any questions during the webinar, just write them down and ask away at the very end. I will do my very best to answer. If any of your questions remains unanswered, then please don't hesitate to write an email to webinars@hotforex.com and they will do their best to give you an answer. So, I am one of the senior traders here in Blue Sky Forex. We provide 24-hour trade support, analysis, just to allow FX traders to make better trading decisions. And Blue Sky Forex is presenting this webinar on behalf of Hot Forex in order to educate you, help you become highly profitable currency traders. So let's take a look at 2 market types you will come across. First of all is price action, aka trending market. This is more powerful. You will definitely have heard the expression trend is your friend, which is completely true. And why it is more powerful is because a significant trendy movement that you can potentially benefit from needs to be fueled by significant news. Okay, some significant event happening on the economic side, the fundamental side, that needs to be driving the price in a certain direction in order for you to properly benefit from it. Okay, that is the reason why it is a bit more difficult to identify as well, because you will need to be somewhat up to date with what news events may be causing this certain price movement on the asset, on a certain asset. Okay, so you need to have a bit of a fundamental understanding of the market. And then we have a mean reversion market, aka a ranging market. This is definitely more common. It is easier to identify due to the fact that when the price is ranging, it is essentially bouncing between the nearest support and resistance level. Okay, we have a separate webinar on support resistance levels as well. Very useful. Support resistance levels are always something that you have to consider when you are trading, no matter what type of trader you are, no matter what strategy you are using, because the price still will move, and it is doing that with support resistance levels in mind, right? Because all the traders are looking at those levels. They are making their trading decisions also based on them and considering them. So you have to do that as well. Okay, you will have higher chances of getting your trades right. So our core strategy, it is a mix of price action and mean reversion, and it heavily relies on Bollinger Bands. Bollinger Bands is a technical indicator that we really endorse here in our team. A lot of our strategies or formations, they do rely on Bollinger Bands because Bollinger Bands, it's an easy indicator essentially to visually read, but it also does provide you with very good, this kind of visually analyzable and identifiable trading setups that you can utilize to make better and safer trading decisions. Okay, so definitely, if you don't know what Bollinger Bands are, what they look like, surely you will see this on a few of the next slides as well. But I would highly recommend just to take a deeper look into them, find ways how you can utilize them. If you don't want to use any of these strategies we provide to you today, there are tons of ways how you can benefit from Bollinger Bands. Okay, so definitely something for you to keep in mind. Maybe check out after the webinar. So here you go, Bollinger Bands. As I mentioned, we don't use a lot of indicators in our strategies except Bollinger Bands. We find it being the best technical indicator there is. I mean, it is easy to read. It's easy to understand. You have the upper band. This is the reddish line at the top. Then you have the lower band, which is the green line at the bottom. And then you have the middle band, which is the gray line in the middle of those bands. And this is essentially the moving average of the price. Okay. And now in the upper and the bottom band, there are a certain deviation away from the moving average, and this composes a Bollinger Band. Okay. So the purpose or what Bollinger Bands do, it essentially attempts to contain the price movements. Okay, so if you draw Bollinger Bands onto your chart, you will see the price mainly moving between the top and the lower band. Of course, it depends what parameters you set for the Bollinger Bands, but if you use the default ones in MetaTrader 4, which is a period of 20 and deviation of 2, then you will see the price mainly moving inside the bonds, and you can see the bonds really effectively containing the price movements. Of course, you will have some breakouts of the price that the price actually moves outside the bands. There might be several candles even being completely outside the bands or just closing outside the bands. This is completely normal. Don't worry. You can actually benefit from this kind of movements as well. Okay. So the price does not always move inside the bands. It can also break out and move outside the bands. But how you can utilize this is just understand the different formations and how the price can move in relation to the Bollinger Bands. Okay. So if you just take a look at the picture quickly, the price is contained, and just by looking at this picture, you can visually see that, or maybe think that just going long when the price reaches the lower band and trading upwards, and going short when the price reaches the top band would make a lot of sense, right? Sure, it does make sense. However, it does not always work. okay? And longer term, if you use the simplistic approach, you will find your account capital decreasing. I'm quite sure of it, okay? So this kind of very simplistic and plain approach does not work. You will have to understand different formations. As it said, it's a recipe for long-term disaster, right? It does not work consistently. However, if you analyze the slope of the Bollinger Bands, the trajectory, the certain positions of the top and the bottom band from in relation to the middle moving average and also to the price, you can find this kind of formations that will certainly increase the odds of you making a profitable trade. Okay. So today we'll be looking at 4 primary chart formations. They are called the channel surfer. It is a price action strategy with a mean reversion entry point. Then we'll take a look at Waterfall and Breakout, which are purely price action. And then we'll have a Hummingbird formation. It's also price action with a macro mean reversion element to it. So let's start with the channel surfer. This is just a bit of writing and a bit of theory behind it, but I think it is easier if you just take a look at it on the actual chart, and I will just explain. Okay. So the very first condition, or the very first thing you need to keep in mind when attempting to identify channel surfer formation, is that you have the middle moving average moving in a certain direction, relatively in a stable way. And you have the bands of the Bollinger Band, the top band and the bottom band, moving in the same direction and being relatively parallel to each other. Okay, you see on this example under my cursor in this area, you see the middle band trending upwards, and you also see the top and the bottom band moving in the same direction, being relatively parallel to each other and to the moving average. So this is the first condition, the first visually identifiable condition that you have to keep an eye out for. The next thing is that you will see the price moving between the middle band, the moving average, and the top band. Okay, if it is going upwards. If it's going downwards, the price is moving between the bottom band and the middle average in the middle. Okay. And how you will be entering the trade on this formation is that you know the price never moves in a linear or a straight line. It moves in waves. Okay, that is where the Elliott wave theory comes in. You don't have to understand it or know it by heart, but understanding it will benefit you in any way, no matter what strategy you use, because you will understand better how the asset prices will move. Now, keep in mind, Elliott wave theory, Google it up later on after this session. Really useful. Anyways, what you will want to do is you want to catch the next move along with the trend. Okay. Now, when the price is moving along with the trend, it is called an impulse wave, and when it moves against the trend, a general trend, it's called a corrective wave. Essentially, the price corrects itself, right? Now, the corrective waves can be in the range of maybe 40% up to 60% in some cases. You see it really rarely correcting 90-80%, and then you have another impulse wave forming. If it usually corrects more than 60%, it's likely that you might be dealing with a reversal instead. Okay. So here you have maybe 50-60% correction after the first impulse wave. After the correction, you have the next impulse wave starting, right? And when the corrective wave reaches approximately at the point of the moving average, the middle band in the middle here, this is where you should be searching for entries, okay? And you want to be trading along with the trend. So at this arrow, this would be the very first entry point, the very first trade you can initiate and benefit from. The next impulse wave starts at the next arrow. Okay, so this would be another entry you could potentially make. Now you do see a bit of difference between these bounces of the moving average. This is, you see the wick exactly being at the level of the moving average. Here you see the candle piercing the moving average and closing beneath it before actually before the next impulse wave starts. Okay, you can trade this either way. It's really up to you. What you find, what suits you best. You can trade this as soon as the price reaches the moving average. It's fine, and just trade along with the direction of the trend. You can also wait until the candle closes at the moving average or just maybe a bit below it, and then trade when the next candle starts to form and you see it, is going up a bit, it's going green, and then you can start trading. Okay. So fairly simple, fairly easy. Just trade the impulse waves, the actual start of the next wave along with the trend after a corrective wave has already finished. And the Bollinger Bands will help you find the entry points for the strategy. A few things to keep in mind. You can use or set a take profit to the equal the distance from the previous higher high and the end of the corrective wave. So just take the distance from this point here. If you see my cursor, the low point of and the end point of the corrective wave, just take this distance and set a take profit to the same distance on the other side of this previous higher high. Okay, so you have like a triangle forming here, right? So the same distance, your take profit would be somewhere here. Okay, if that made sense. Another thing is that you don't really want to be trading the first bounce off the moving average. I would start looking at trading opportunities starting maybe from the second bounce is okay-ish, but I personally usually wait for the third touch of the moving average and then trade along with the trend. And I usually trade one trade per channel surfer formation. If I see an extremely strong trend forming, then I also sometimes trade the second trade in the same formation, but not more than that. Okay, trading the second or the third bounce or the third or the fourth bounce. Going along with the fifth is a bit riskier because you will or you might see some exhaustion setting in already, and you might be looking at a potential reversal coming up soon. Okay, so just to keep that in mind. Now let's take a look at the next formation. Also a bit of a theory behind it. You will be able to find the recording of this webinar in the Hot Forex past webinar section. Just log in, go to the educational section where you registered for the webinar today, and you will find a link to the past webinars there, and there you will find all the past webinar recordings. If you want to read this through again, or if you want to check out this webinar again in the future. So a waterfall. You might have heard this term before, trying to find strategies. This is what a waterfall looks like. Okay, you have many consecutive same directional candles in a row that are relatively stable, without large wicks and quite formidable bodies. Okay, so The conditions are fairly simple. Again, if you see at least 4 consecutive red or green candles or whatever other color, they just need to be same direction, in the same direction. They have to have a relatively stable, what it means is equal in size bodies to each other, and they cannot have large wicks. Okay, so stable movements in the same direction throughout more than 4 candles, and then you simply trade in the direction of the trend. Okay, so fairly easy. It is also quite easy to identify, but finding one formation like this that actually is justified might be a bit tricky, because you will need to understand what is fueling that certain move. If there is no significant news actually fueling this consecutive stable move in one direction, then there is no point to take the risk to trade it. Okay. If you see some significant news fueling that certain move, then this formation is relatively profitable and relatively good to trade. Okay. I won't say it's safe to trade, because trading is not safe. Trading always includes risk. Just keep that in mind. But it is one of the safest formations to trade. Let's put it like that. Okay. Just look out for the news. Look out for the consecutive candles without much wicks and quite stable movements, and then trade it in the direction of the trend. Okay, the downwards waterfall on the left side here isn't really the best example, but the green one is a relatively good one. So the next one, let's take a look at Breakout. So a Breakout is heavily reliant on Bollinger Bands, because Bollinger Bands will indicate quite clearly when a breakout is happening. Breakout is actually breaking out of the Bollinger Bands, right? So it's a reference to the Bollinger Bands position anyways. So Bollinger Bands are really important here. Now, if you look at, you have quite a hectic and really wicky movement here, right? You have a lot of wicks here, a lot of indecision. Then the price drops down, and then you see price consolidation, right? So it consolidates, it calms down into a very narrow, this kind of range. And this also causes the Bollinger Bands to constrict into a narrow channel, okay? So this large movement caused them to, for the channel to widen up. This consolidation caused it to constrict heavily into a narrow, this kind of range, narrow channel, okay? And this quite often and usually happens prior to significant news releases. The traders, they are stepping out of the market, they are waiting for the news to be released, and then they are making their trading decisions. They are then opening up their positions. That is the reason you see the consolidation in the price. Okay, the asset is calming down because traders are just waiting for the news to be released before entering the trade. So, price consolidation, Bollinger Bands constricting into a narrow channel, and then the news releases and you see price starting to move again. Your entry point would be as soon as the first candle closes outside of the Bollinger Bands. So on this occasion, you can see the price, or this candle here under my cursor, if you see it, it's nearly closing outside, or it's closing at the very top Bollinger Band, okay? If your risk appetite is high, then you can enter on this candle already. Although if you want to trade as safe as possible and want to follow the rules extremely strictly, then this next candle here, you can see it clearly closing outside the bounds, and you can wait for it to close and then trade along with the trend on the next candle upwards. Okay, so this is a North Bollinger breakout. Okay, if you see this formation and you haven't been able to identify any significant news hitting in the market at that time, then you might end up with what we call as a fake out. Okay, so you have narrow Bollinger Bands, they are constricting. The price closes outside the bands for one or two candles, but then reverses because there is really nothing else to drive the price in a certain direction. Okay. So definitely, this is also something you need to trade with the news, like Waterfall. All right. So the next one we have is the Hummingbird formation, and this is a bearish signal. Why we named it the Hummingbird, we also drew a Twitter bird on the side for you to visually relate to. You can see it is a bit, it looks like an hummingbird a bit, right? You have the tail here, you have the belly, you have the head forming here, and then you have the beak. Okay, so it looks like a hummingbird. It looks like a small bird, right? So that's where the name came from. Anyways, what happens here is that during the London session, during the European session, where you have quite high volatility, you see an asset price moving in or trending in a certain direction quite a bit. Okay, so when the London market closes, you see the certain asset experiencing some exhaustion already, some indecision, and after the London closes, the price usually starts correcting itself somewhat. Okay, so a rally during the European session, and after European session closes, the price starts to correct itself, and as this is a bearish signal, you can trade short when the price reaches approximately, at the start of the peak, and then just trade downwards. Okay, and this is an end of day signal. You can trade this until the end of the US session. Okay, now something to keep in mind that this is best traded on a 15 or 10 or 15 minute chart, because if you move to a higher time frame chart, you will have really the body forming throughout several trading sessions, and eventually if the price reaches the peak of the hummingbird, you are already trading during the next London session, for example, the next European session. So it's not really the ideal chart time frame, the 1 hour and onwards. So a 10 or 15 minute chart time frame will do on this occasion with this formation, because in this case you will be able to trade until the end of day. Right? So again, decent price rally during the European session. After the European session closes, you see the price starting to see some exhaustion and correcting itself, and just trade short at the peak of the hummingbird. And it can be an end of day trade. So these were the 4 formations, quite straightforward. If you want to check up the conditions again, then please definitely check the webinar recording on the past webinar section, and then just pick 1 or 2 and try to find these formations on the price history, or attempt to identify the formations on an active live trading environment. And if you practice and keep on practicing and being consistent, then you will master one of these strategies, and I'm quite sure that these strategies, they will serve you well if you know how to use them. Okay, it's actually like this with every strategy. Any strategy that you know how to use, you know how to utilize during different market conditions, will serve you well. One of the tricks is to be able to identify the certain market conditions where the strategy performs. Okay, no strategy performs well in all different market conditions. I don't think it's even possible. Okay, um, when you started or when you enter this industry, I'm quite sure you also ended up, trying to find a strategy online, developed by somebody else that you could use also to be profitable, right? I'm quite sure many or most of you were down that road. And at some point you came across this kind of uh, a name, a holy grail, right? This kind of term, the holy grail. I'm quite sure you have heard of it. A lot of people are looking for the holy grail, the strategy that will always work and will always be profitable. Okay, that's what they refer to as the holy grail. Now, I was also down that road when I started, and I can, out of my years of experience, I can say, at least according to my experience, that holy grail does not exist. Okay, most likely you will also come to that a conclusion if you're still looking for it. At some point, you will find that it doesn't exist. If it does exist, then we don't have access to it. Okay, then only the big players know what this is, or they have access to it. But I haven't found it. Uh, Tens of thousands of other traders haven't found it. So there you go. But if you learn to use these strategies and if you understand when these strategies work, then you'll be better off with using the strategies that you can also master. Okay. We actually have also another webinar that is directed to strategies alone. What they are, what they consist of, etc. So we discussed there what you have to or what you should keep in mind when you are searching for a strategy or when you are developing one, and what you need to know and understand in order to find or develop a strategy that will serve you longer term. Okay, so highly recommend either attending that one or just checking it out on the past webinar section. Now, let's move on to risk management. This is also a very important topic. Managing your risk is a very important aspect to trading. Why also a lot of people fail that they fail to understand that their trading is risky, and they fail to set their trading rules, right? That they could follow. And following the rules that you set for yourself, it is part of your trading strategy as well. And then failing to follow these rules will cause damage to your account. Okay, so you should figure out a certain percentage that you are willing to risk or lose in a single trade. We would say that this percentage should not be higher than 1% of your total account equity. So this means that no single trade should be able to cause a higher capital loss than 1% of your total account capital. Okay, so 1% should be maximum per trade. All right. If you get more experienced, then you can of course raise this percentage, but one is quite optimal for all um, trading styles, for all um, market types. For any approach you use, 1% would be optimal. Okay. Another thing to keep in mind is that if you encounter a loss of 5% of your total account capital during a single trading session, then simply close down your tools and walk away and return on the next session. Okay? So you can also use the Kelly risk management formula for advanced traders if you want. But you can still simply keep it at 5%. This is also an optimal value. There's really no point to go above that because otherwise you'll be risking too much during a single trading session. And perhaps, that's the market conditions during that single trading sessions were not really optimal for your trading strategy or the approach you use. So there is really no point to put more money on the table and just give it away. It would be better to just, cut the losses and move on. And just then you will be able to return on the next session. Maybe the market conditions are better for your trading strategy, and you can actually earn that 5% back and make some profits on top of it. Okay. So definitely set these trading rules for yourself and please try not to break them. Well, let's talk about chart calibration. So if you want to use any of these strategies we talked about already, you should have access to the chart provider that gives you 15-minute, 30-minute, 1 hour, and 4-hour chart timeframes. I'm quite sure you already have it because most of retail traders use a MetaTrader 4. Most brokers also provide access to a MetaTrader 4 platform that connects to their servers. And MetaTrader 4 has 15, 30-minute, 1 hour, and 4-hour chart time frames available. Okay. The next thing, you should set your visual charts to candlesticks. Okay. Candlestick charts, they are easily understandable, they are easily readable, they look visually easy to understand, and there are certain candlestick patterns that you can also identify. I would highly recommend to Google candlestick patterns. You will find a lot of different patterns online, like 3 hanging men, shooting stars, hammers, etc. You don't have to learn them by heart, but if you understand them somewhat, then you will raise your accurate trading chances as well, because you will understand when a potential reversal might be coming up, because candlestick patterns, they will give you hints about what the market might be doing after an hour or so. Okay, just as an example. So candlestick charts are really useful. And add Bollinger Bands. Again, the Bollinger Bands, our favorite technical price analysis tool. Easy to read, easy to understand, and will provide you with different formations that you can visually find and identify to benefit from. The standard settings or parameters for the Bollinger Bands will do a period of 20 and the deviation of 2. You can, of course, raise them to a period of 25 and deviation of 2.5 during extremely volatile markets. That is completely okay. But using any larger values than that, I don't really find them to be too optimal. Okay. The next thing to keep in mind that please stop trying to be serious about trading and trade from either a mobile phone or a tablet. If you want to be a serious trader, if you want to be making money longer term, if you want to attempt to be profitable, if you want to have this chance to be a profitable trader, then please use a proper desktop computer with at least 2 screens, 2 decent screens, like maybe 27 inches and upwards. This will give you a good environment to trade. Okay. If you have at least two large screens, then you can organize your workspace in a way that you will be able to identify and properly visually analyze the price movements on the charts. Okay. If you use a very cluttered workspace, or if you use very small monitors and small workspace, then the ability to properly analyze the price movements will um, deteriorate. Okay, so regarding the actual currency pair amount, I personally use or analyze 9 charts at a time. Okay, I found this ultimately in longer term to be an optimal solution for me, at least, right? I mean, it highly depends on the actual trader and the person, how much you can analyze adequately, but you should not start with more than 6 currency pairs, okay? 6 is completely enough for you to provide yourself with enough trading opportunity, enough pairs to look for potential trading setups, and this case you will not overwhelm yourself, okay? So don't stress yourself with too many charts, and please try to keep the charts clean. This is really important. If you add a lot of indicators onto the charts, some of the indicators, they actually draw themselves on top of the price itself, like moving averages, for example, Bollinger Bands. Some of them draw underneath or just above or on the side of the actual price charts. All of these, they clutter up your workspace. So try to refrain from using maybe more than 2 or 3 indicators on one single trading chart. Okay. Maybe you can add, Bollinger Bands. It also already includes a moving average. Then maybe set an RSI at the bottom, and that's fine. You have still a clean and visually analyzable price movements, because the price movement is the actual very and the most important thing to analyze when you're making your trading decisions, not the indicators. The indicators are just tools to assist you to identify in what condition the price might be in at the moment. Okay, or depending on the indicators, of course, some of them might give you some insight if the price is overbought or oversold, and what the price might be doing next potentially. Okay, the most important thing still to analyze is the price itself. Okay, so please keep that in mind. There are tons of traders who simply trade with no indicators whatsoever. They simply analyze what the price is doing. Okay, they're just trading the price action, what the price is doing immediately, and then trying to catch the trends, maybe analyzing the candlestick patterns, etc. So don't clutter up your workspace. When you're starting, 6 charts maximum. When you get better, when you find that you need to have a bit more trading opportunity, then set it up to 9 or 12 or whatever you feel comfortable with, but don't overdo it. Okay. Now, regarding your stop loss, take profit levels, it actually depends on your trading style. If you're a scalper, then obviously you're aiming for these low pip gains like 15, 25, 30 pips. But if you are a position trader, then obviously you want to aim for higher pip gains like 100 and 200 pips, etc. So being able to understand if you're a short-term or longer-term trader, it helps you to determine where to set your take profit and stop loss levels. What every trader, however, needs to keep in mind is the actual risk-reward ratio. So if you're setting it to 1 to 1 is completely fine. That means that your Take profit level is the same distance from your entry as the stop loss. So let's say your take profit is 30 pips, then your stop loss would be 30 pips away as well. Okay, so that's a risk reward ratio 1-to-1. If you get better, then obviously you want to raise your risk reward ratio to the positive side and give you a bit more chances to earn more. So raising your risk reward ratio to 1-to-2 will result you in having your take profit level twice the distance of your entry than your stop loss. So your take profit would be then 60 pips and your stop loss would be 30 pips. So you're potentially aiming to win twice as much that you're potentially risking to lose. Okay? And if you consider yourself an expert trader or a really, really advanced trader already, then obviously you can use a risk reward ratio, 1-to-3 and maybe up to 1-to-5. But going anywhere above 1-to-5, I find it being already too much, because if you set a really unrealistic risk reward ratio, then you will render your trades not being able to hit the take profit level. And before they actually even get that far, the price will reverse and will hit your stop loss level instead. Okay, so keep the risk reward ratio reasonable and understand how much experience do you have. Okay, just find the best ratio that works out for you at this point and stick to it until you become better, until you find that the more positive risk reward ratio would allow you to earn a bit more profits than usual. Okay, so last but not least, let's take a look at some currency trading dangers. So try to refrain from allowing some automated system to make trading decisions and trade on your account in behalf of you. These things are dangerous, and most of them are designed to generate losses on your account. So we're talking about anything that trades in behalf of you, any robot, expert advisor, any other third-party system that interacts with your trading platform, anything. If you want to try any of these out, please sure to do so on a demo account first. If you see it generating profits consistently without large drawdowns on your account for extensive amount of time, like 4, 5, 6 months and onwards, then only decide whether you want to set it up live or not. And if you do decide to set it up live, please use low lot sizes because you want to trade as safe as possible. Okay. Now, sad but true, but only 5% of the retail traders make money longer term in FX. The main reason behind this is it's simple. It's our brains. It's how we operate, right? It's a certain chemical patterns that are released in our brain when we are trading. If we go on to a winning spree, we have a lot of adrenaline in our brain. We feel invincible. We feel we want to win more, and we cannot lose. Eventually, you'll end up over trading, and you will either lose some or all of the profits that you have already made this far during the trading session, or even earn some or generate some losses eventually at the end of the trading session. Really dangerous. Okay. On the other hand, if you are on a losing streak, you will have different type of chemical released in your brain, and what happens essentially is a medical term is amygdala hijack, that your reptile brain will take over. You will go into a revenge mode. You want to earn back the losses that you have already made this far during the training session, and you will end up losing even more or just completely emptying your account. It has happened to a lot of retail traders. Make sure that this does not happen to you, and to prevent this from happening is setting really, really strict trading rules, okay, and not breaking those rules. Now, emptying one of your accounts is actually not completely a bad thing, because it is a lesson. It means that you need to change something. You need to change a part of your strategy. Okay, don't change it completely, because jumping from one strategy to another, you will render yourself searching for a strategy indefinitely. But changing a part of your strategy is something you need to think about, because obviously you are doing something wrong. Okay, so if you empty one or two accounts, take it as a lesson, change some things around, practice, learn, study, and try again. Okay. Now, one thing really important to keep in mind, and I want to stress the fact that emptying one or two accounts does not guarantee you becoming a professional trader ever. Okay, it does not guarantee it. It's just a part of most traders' journeys. Okay, every professional trader, I'm quite sure, not every, but most of them, if not everyone, has emptied one or two accounts in their beginning phases, right? So have I. That's completely that's okay, right? But it doesn't guarantee you becoming a successful trader longer term still. So please definitely keep that in mind. And last but not least, only 5% of single services, maybe even less, and single rooms are legitimate. Okay, so if you want to try one of these out, please ask for a proper performance record from that single service or single provider and an audit trail. And if possible, ask for the experience of some other users who have already used this service. See if they have been able to generate profits longer term with that certain single provider without any large drawdowns, of course, and only then decide whether you want to continue or not. Okay, so this is it from my side. Let me just then open the question section and answer them as let me catch them as many as I can. We are running out of time in 5 minutes, so just bear with me for a moment. Okay, second is asking, how does one set the stop loss? I'm suspecting you are talking about how to set it up in the MetaTrader 4. It is fairly easy. There are two ways. When you are initiating the trade from the actual trade module, then you can define the take profit and stop loss levels manually. If you are initiating the trade via the fast trade module, like just pushing the up or down button, then you can also, after the trade is initiated, you can pull with your mouse cursor. If you're going long, then you can pull from your trade entry line just beneath the current price. That will set a stop loss. If you're trading short, then you just pull it upwards. If you are thinking about how to define the stop loss in pips, and then you have to think about the risk-reward ratio and what type of trader you are. If you're a scalper, then you obviously have these set to lower pips. If you're a position trader, then obviously have it set to more. But just consider your risk-reward ratio that you are aiming for and act accordingly. Okay, Olusegun is asking or saying that I'm currently trading exponential moving average strategy, but I noticed my stop loss is always twice my take profit. What should I do? Okay, then you're right now using a negative risk reward ratio. The idea already of potentially losing twice as much as potentially winning from a single trade, surely you might have an increased trade accuracy. But if you lose one trade, you need actually 3 positive trades to make up for it and earn some profits, right? So it's a bit of a bad position to be in, because every losing trade causes more stress, right? Because you have to think that now you need to make 2 successful trades in order to make up for it. And if you want to make profits, you have to have 3 winning trades to make up for the loss. Now, what you can do, I mean, first of all, you should revise your strategy. Second of all, I would move on to a demo account and test out if you use the same strategy but with a risk-reward ratio 1-to-1. Either raise your take profit level to match your stop loss level, or move your stop loss level closer to your entry price to match the take profit level. Okay. If you're I understand that you want to give the price some headroom to move because you are using a moving average strategy. But giving it too much room will not always be good, because sometimes you will hit the stop loss before the price moves in your direction. So test it out on demo account. See if that strategy still works with this risk-reward ratio or not. Okay. Adewunmi is asking, how can I get a recorded copy of this session? If you log into HotForex account on the website, go into the education section where you can see the upcoming webinars list. You will have a link there that will lead you to the past webinars, and there you will have all the recordings of all the webinars that have happened in the past based on different topics. So you can find it there. Netson is asking, how would you know you are being faked out after 2 candles close outside the bonds? Okay, I'm quite sure you're talking about the breakout strategy, the breakout theory, right? Okay. If you see this formation and you see the price closing outside the bonds, first of all, please determine if there has been a proper news release causing the consolidation and then the immediate price move in a certain direction. If so, then you can trade it. If you're unable to identify any event potentially causing this breakout, then it's best to stay away. Okay, Alavore is asking, how does spread affect the trading decisions? Okay, now first of all, spread does not affect trading decisions per se. Spread affects the trading outcomes, right? Now, the largest impact that spread has to your ultimate longer-term trading outcomes is whether you are a scalper or a longer-term trader, whether you're a short-term or longer-term trader. If you are a short-term trader and you initiate a lot of trades during a single trading session, then spread will hurt you more, because with each and every trade, you have to accommodate for the spread, right? Each and every trade will include spread. You are paying some amount to the broker. Okay, so the more trades you initiate, the more spread erodes into your profits. If you are a longer term trader and you maybe initiate 1 or 2 trades during a single trading session, then spread is really less of a problem. Okay, I mean, spread will always be there. Okay, so just for you to keep in mind, depending on accounts, of course. Okay. Irene is asking, where would you set your stop loss in the breakout strategy? Fair question. So let's take this example. Sorry. Let's take this situation as an example. Let's consider that this is, if you see the cursor, this candle that has the wick here is closing outside the bonds, right? And you would be trading this next candle here going upwards. Then your stop loss should be at the very, it can be at the lower Bollinger Bands, okay? Or you can consider the previous lower low of the price when it was consolidating as a stop loss. Okay, Enan is asking, what does RSI mean? RSI is a relative strength index. It's a technical indicator that will provide you with information whether the price is overbought or oversold. So relative strength index, you can Google it. You can definitely find a lot of information about it. It's a relatively popular technical indicator to use. If Yoluva is asking, how many consecutive losses would one have to make before walking away? It's a really good question, but it doesn't really depend on the amount of trades. It more depends on the risk reward ratio that you have set, per trade basis, the risk management rule of 5% complete 5% of total account equity loss before walking away. So you can simply rely on that 5% rule, or you can also follow the risk reward ratio set for a single trading session. Okay, so let's say if you want to earn, or if you aim to earn 100 pips profit in a single trading session, and let's say your risk reward ratio is 1:1, then you would also expect to lose 100 pips. So whenever you reach that 100 pips, then you will just simply stop and walk away. Netson is asking, is spread deducted if trade is cancelled soon after placing it? Yes, of course. Whenever you enter the trade, the spread is also incorporated into your trade entry. So if you immediately start trade and immediately cancel it, then you will still pay the spread. Okay, we are already 5 minutes past the 1 hour mark. At the moment, all the questions have been answered. If you have any other questions still in mind coming up, then please don't hesitate to send them to webinars@hotforex.com, and they will do their best to provide answers. From my side, it has been a great pleasure hosting this webinar today. I'm really glad so many of you attended. And from my side, please trade safe, and I wish you a great rest of the day. Take care, everyone.